in the midterms, we probably, as we usually do, in the midterms, have a changeover or a loss of seats for the incumbent party in the House, and that will probably turn the House this time. And so I think that the policies looking forward will be focused on getting spending, taxes, regulation down, and maybe opening up the spigots a bit more in terms of energy production here in this country instead of going to Venezuela or Saudi Arabia. Monetary policy, well, let's just look at the numbers first. M2 growth peaked at 27% in 2020 and has been slowing ever since. It hit 4.1% in August. We believe it is closing in or might be below 3% on a year-over-year basis in September, which doesn't leave a lot of room for growth or inflation unless velocity is really picking up, the rate at which money turns over. And we're in an environment where we do not believe velocity is picking up. If anything, I think individuals and businesses are becoming more concerned the kind of slowdown in monetary and fiscal policy that we're seeing right now. Federal spending is still down 14% on a year-over-year basis. You never saw a decline in fiscal policy spending in the 70s. Monetary policy seemed to be on automatic pilot back then. The dollar was getting crushed toward the end of the 70s, adding to the inflationary fire. And so Chairman Volcker did choke off money supply and killed inflation. It took a long time for people to believe that inflation had peaked. In fact, I don't think many people believe it peaked as it did in 1981 until 1986 when oil prices crashed. So the inflation expectations were embedded in the system, and it was very difficult, and Volcker did a masterful job. So that was over a 15-year period that inflation had built. By the time the Fed got around to tackling it this time, it was not a 15-year problem. Today, we've gone from 0.25% on the Fed funds rate to 3.25, which is a 13-fold increase, not a two-fold increase. Now, many people, I was interviewed by someone the other day and said, oh yeah, but that was such a low base. There's no comparison. In fact, that makes this even more dramatic. That's what's so interesting. People dismiss this way of thinking about it, saying, oh yeah, but the base was so low. The base was so low, and it had been really since 2008 and 9, because we were in a terrible crisis then. And it took a long time to get out of it. And so we did not have inflation expectations built into the system. I really don't believe at all. And yet Chairman Powell is behaving as though what's going on today with inflation is much worse than what Volcker inherited. Starting from a low base is really shocking the system, especially given how long interest rates have been low. So I question the premise of those who say, oh, this is so different. It's such a low base. That's the whole point. It's a low base, 13 times. So if they raise the Fed funds rate another 75 basis points, this will be a 16-fold increase compared to Volcker's two-fold increase in interest rates. Well, once that happened, pensions began getting margin calls, and they couldn't meet them. And in fact, if interest rates had gone to 8%, and I think they got to 6% over there, if they got to 8%, then according to some of the people close to that situation, whom we have consulted, then the pension system would have collapsed. But it wouldn't really have been the pension system. What really would have collapsed if the pension funds were not meeting those margin calls, were the banks, the counterparties in this case for these derivatives. And so the Bank of England had to step in and basically say pretty much the same thing that Draghi said, the chairman of the European Central Bank in 2011. He basically said, we're going to pull out all stops no matter what. So while the BOE had been almost forced because of currency depreciation into following our Fed with higher interest rates, so we'll see what happens on October 14th. By that time, I think they will have been deleveraged and will be past the maximum pressure associated with this guilt trip, which is why we called this in the new series guilt trip. We're seeing other changes. We've seen China intervene to limit the weakening of the yuan. We've seen Japan doing the same. Now, what is that? What are they doing when they do that? Well, when Japan is trying to support its currency at 145 yen to the dollar, what it does is it sells dollars and buys back yen. Now, that's good in a way. It's doing some of what the Fed should be doing here, actually. It's providing dollar liquidity to the rest of the world. China is doing the same thing. And so we'll see what happens from here. I think this is getting to be so serious that we are reaching a cathartic moment. And I do think it started with the guilt trip. A lot of mine, too. It dropped 0.3% in the last month. And that makes for 5 consecutive months of decline. And the rule of thumb there is once you've got 3, you know you're in a recession. So the Fed may be saying that it's data dependent, but it's looking at the data it wants to look at. It's not looking at the totality here. It's also making an assumption that we think is mistaken. It's very much a Phillips curve Fed. Now, that's a very Keynes economic theory concept. And it basically says that rising output and employment causes inflation, or they're at the very least highly correlated. And that's just not true. If you look at the data, 80s, 90s, 2000s, you'll see that inflation came down during times when the economy was very strong. Why? It's because of productivity. Productivity growth is a byproduct, and a critical byproduct, and an anti-inflationary byproduct of good, strong recoveries. So, we shall see. All right, on to, and I'm going to refer to some numbers here that my colleagues prepared. So let's go to the commodity prices. Again, data-driven Fed. Are you listening? So